Good afternoon, everybody. Today is Sunday, 13th of June, 2021. We will be discussing the concluding part of our discussion on accounting for leases with respect to the requirement of IFRS 16. And yesterday we had part one, and the recording session of part one has been released. It's about 6-hour session. And today we'll be wrapping up on the other aspect of leases with respect to IFRS 16. Before we more or less venture into what we need to discuss today, I will first of all try to reiterate one of those things we discussed yesterday. And if you check the discussion we had yesterday, we started with the objective for having this standard. And we venture much more to understanding that there are two perspectives to which leases are accounted for. The perspective of the lessee, who is a customer, and the perspective of the lessee, who is the supplier of the specified assets. We went further to define what a lease is and identify the attributes that is contained in a lease. And went further to identify that a lease must emanate from a contract, which is from the legal perspective. And not all contracts necessarily will contain a lease, but a contract that contains a lease must have it spelled out clearly, the right of use of assets that is granted by the supplier, which is the lessee, a lessor, to the customer, which is the lessee, for the use of a specified asset, which is underlying assets. We went further to discuss on what are the attributes to understand that there is a specified asset. Looking at first, that there is control over the assets, which brings about we identifying that the lessee, which is a customer, substantially is to benefit or enjoy the economic benefits associated with such a lease assets, and that the lessee directs ultimately the use of the assets. Furthermore, we venture into understanding that the assets must be clearly specified and is an asset that cannot be exchanged for another at will from the perspective of the lessor, who is the supplier. We want further to look at the chart that is given as an illustrative guidance by the IESB in the standard. And that chart more or less gives us clue towards easily identifying if a contract contains a lease or contain other form of engagements or services. Also, we went further to look at scenarios, about 3 scenarios to identifying whether we have the understanding of how we can identify or determine if a contract contains a lease. And having done that, we ventured into discussing on leases accounting. That is, from the perspective of the lessee, how do we account for a lease? We said IFRS 16 was a paradigm shift from the requirement of IAS 17 with respect to lessees accounting, and that IFRS 16 makes use of a single economic model that allows the lessee to simultaneously, as it recognizes its lease obligation, correspondingly recognize its right of use of the assets. And went further to give 2 exceptions to the rule of this single economic model. And the exceptions borders on if a contract do contain a lease, but the contract is a short-term contract that does not exceed a 12-month period. Or a situation where a contract might be long-term contract, but is of a low value. Though we discussed that the standard did not clearly define what a low-value contract is, but a low-value contract is viewed from the instance and judgment of an entity on the principle of materiality, okay, and other substances that surrounds it. And the standard gave us little guidance about identifying what would be considered low-value contracts. Okay, low-value assets leases might be attributed to those where you need to lease some office equipment of little or no significant material value to the business, even though it is employed by the business. Some of them are like computer equipment, laptops, and some other things. In that situation, we may not, or we may deviate from the requirement of IFRS 16 from the angle of the lessee in accounting for such in the manner in which we need to have adopted the single economic model. And we went further to discuss how we account for those that does not fall within the single economic model. Furthermore, we try to identify and distinguish between the inception of the lease and the commencement date of a lease with respect to recognizing the lease assets and the lease liability at the commencement date. We try to look at various terminologies, and one of the key terminologies that came into bear are the rights of use of assets, which connotes the lease assets, the lease term, which is the shorter of the useful life of the assets, and the lease period, even though there are some exceptions to that rule based on the fact that there might be purchase option, or there might be an option to extend or renew the lease term. We also discussed about interest rates implicit in the lease, and mathematically we're able to identify how such is being determined, and went further to determine what are the components of lease payments, starting from fixed payments, variable payments, subject to those that are attached to index or market rents. We discussed about purchase options and probably where there are penalties for termination, if any. And we also talked about how that is reduced by lease incentives that are made by the lessor to the lessee in form of cash or reimbursables. Okay, we went further to discussing how lease liability is measured with respect to present value principle, and how we make use of the interest rate implicit in the lease to discounting the associated cash flows in the lease. In the absence of obtaining the interest rate in the lease, we are allowed to use the incremental borrowing rate of the lessee in this circumstance. Okay, we went further to discuss how the lease asset is recognized and subsequent measurement of such in line with the requirement of IAS 16 as it relates to depreciation, and IAS 36 as it relates to impairments. And also, in addition to that, upon initial recognition of a lease asset, we equally recognize any form of asset retirement obligation or dismantling cost or restoration cost in line with the requirement of IAS 37, which is equally in tandem with the requirement of IAS 16 with respect to such an item that can be classified as property, plant, and equipment. We went further to discuss that even though the cost model is a default model to recognizing the right of use of assets, we can equally harness other models depending on the nature of the right or of the specified assets. If the nature of specified asset falls within IAS 16, we may adopt revaluation model, which is an optional model from the perspective of the entity. And all provisions regarding such a model in line with IAS 16 will equally apply. And if it relates to investment property, we also establish that such will have to be accounted for using fair value model if such option arise. And this is even compulsory once it is observed that the entity has similar assets in use prior to now as investment property and such has been measured at fair value. Okay, we went further to discuss the presentation. Our right of use of assets is shown in the balance sheet as a component of non-current assets, and how the lease liability is shown in the balance sheet under liability, which will be required to be splitted into current and non-current portion in line with the requirement of IAS 1, even though IFRS 16 does not explicitly require such classification or such grouping. Now, we went further to look at variable payment in real terms and some other key issues with respect to that. And one of those things we did also was to develop a model, a financial model to measuring and accounting for leases from the perspective of the lessee. And we'll make use of about 3 different scenarios to demonstrate our understanding of the requirement of IFRS 16. And that brings us to close yesterday. And today, we will continue from where we stopped in order to wrap up our discussion. I want you to make 1 or 2 comments as we move on in this discussion. Over to you guys. Any commentary?
Okay, so I'll just make a simple comment, which is just that I am very, very satisfied with this lecture, especially IFRS 16, and the fact that everything is clear and we can see everything done on the Excel model. It's just like a picture that you can't easily forget. So that makes it very interesting, and I just want to appreciate and commend your work. Thank you very much.
Okay, let me say this. Good afternoon. To be candid, I think this one is very, very straightforward, and vis-a-vis what I learned before, this one is not comparable, because I learning about it yesterday was like almost like I've never learned about IFRS 17, IFRS 16 before. So basically, it is the learning was simple, straight to the point. It was modeled, and I don't think after yesterday's lecture, probably with whatever we learned today, one can actually forget. It's an unforgettable kind of experience and learning. So it makes it very simple, and you can easily go back to it, and So I think for me, it's like something new. But what I would just add is that I remember then, in terms of those 2 criteria, those are exceptions, in terms of a low value and within 1 year exceptions. The low value, a figure was placed on it. I'm trying to look at my note for that lecture. I think it's about
$5,000. I think it was $5,000.
Yes, a figure. Yes. So when I converted it to NERA, it's like $1 million thereabouts.
Yeah, because I can remember I saw something like that in literature too, $5,000.
Yes. So a figure was placed in dollars. Yes, I think that $5,000. About less. So a figure was actually placed on it at that time. So, but based on what I heard yesterday, he said it depends on the materiality threshold of the entity. So I think I would like you to shed more light on that. Why is it that figure is placed on it by some entities, by some institutions? And I don't know, is it a deviation from what the standard actually says or what? I want to get that mix up really cleared. Thank you.
Okay, thank you. Well,
Yeah, I just want to appreciate your teachings, the manner and approach with which you've been teaching us, particularly this topic. I can't quickly forget, because as we're, showing more light to what we learned yesterday, I was just flowing, and I know that it has come to register in me. This particular topic. I've always been learning from what you've been teaching us, but this I actually, because of the nature, when I was in school, to be precise, I always dodge anything that has to do with lease. I always dodge it. But now I think it's made simple to me. Thank you. I'm grateful.
Mr. Nuruddin, welcome. You came late today.
Yeah, apology for joining late. I haven't apologized. I actually have one or two comments with respect to lease. As a matter of fact, I really appreciate IFRS 16, especially the modality adopted by Mr. Muiwa to handle this particular topic. As a matter of fact, there is clarity in the presentation, and it gives more light to what I know about lease before. Thank you very much. I sincerely appreciate. Thank you.
Thank you. Okay, now let me try and share something with you guys. I think I believe you have access to it before now, okay, but I'll also share it on the screen with me here. Okay, this is a copy of the standard. Okay, this is the red book, part A, with the standard explicitly. Now, recognition exemptions. A lessee may elect not to apply the requirement in paragraph 22 to 49. And the only exception is for short-term lease and the lease for which the underlying asset is of low value. Now, there's a guidance here, which I also mentioned yesterday. And let's look at the guidance. I want somebody to read it up. I'm at that point here.
Okay. Recognition exemption. Leases for which the underlying asset is of low value, paragraph 5 to 8. B3, except as specified in paragraph B7, this standard permits a lessee to apply paragraph 6 to account for leases for which the underlying asset is of low value. A lessee shall assess the value of an underlying asset based on the value of the asset when it is new, regardless of the age of the asset being leased. B4, the assessment of whether an underlying asset is of low value is performed on an absolute basis. Leases of low value assets qualify for the accounting treatment in paragraph 6, regardless of whether those leases are material to the lessee. The assessment is not affected by the size, nature, or circumstances of the lessee. Accordingly, different lessees are expected to reach the same conclusions about whether a particular underlying asset is of low value.
Word size, not affected by size, nature, and circumstances. But the guidance is such that they want everybody to more or less arrive at the same conclusion, regardless of who you are. with respect to classifying an asset under a lease of low value. Okay, let's continue.
B5, an underlying asset can be of low value only if A, the lessee can benefit from use of the underlying asset on its own or together with other resources that are readily available to the lessee, and B, the underlying asset is not highly dependent on or highly interrelated with other assets. B6, a lease of an underlying asset does not qualify as a lease of a low-value asset if the nature of the asset is such that when new, the asset is typically not of low value. For example, leases of cars would not qualify as leases of low value assets because a new car would typically not be of low value. B7, if a lessee subleases an asset or expects to sublease an asset, the head lease does not qualify as a lease of a low-value asset. B8, examples of low-value underlying assets can include tablets and personal computers, small items of office furniture, and telephones.
Now, you can see that in all of these guidance, you understand, is enough for you to identify. It's not about building threshold of 1 million, what do you call it, $5,000 or 1 million. There are more of substantial qualitative attributes that have to be taken into consideration. Another thing that the standard also mentioned is that if an asset by nature will have a purchase option at the end of the day, you understand, even if you lease the asset for 6 months or 12 months, which is of short term, but in that lease, there's an option which is more likely than not to be exercised to purchase it by the lessee. Such will no longer be considered to be a short term. Okay, which means we need to understand, we need to start to appreciate more of the substance than just the letter of the words or by way of threshold. Now, what is significant here is that when you look at all of these quantitative attributes, it should be able to provide you exclusive guidance to know asset of low value. And this is exactly one of those things I mentioned in part 1, where the standard only gave example or explicitly gave an example with respect to describing nature of such an asset, not quantifying such an asset. You get what I'm saying now? Okay? What I might suspect is that initially, when the standard may have been issued, such guidance of monetary amount might have been included. But remember that changes has always occurred even before it takes effect and even after it takes effect, based on various commentaries, feedbacks, and annual improvement that is done to standard on a cycle basis. Does that answer our questions now? Take note, anything you come across, you also have the responsibility to cross-check with the standard. It's like when you go to church and they preach, they tell you things, you also have the responsibility to go to the Bible, which is a source of all of information that is being disseminated by the priest. Okay, that is that. Okay, thank you very much for that. I think, I believe all of you still have the standards. Okay. Now let's move further to our discussion today. We'll start today's lecture with modification to a lease. And we are still discussing from the perspective of the lessee. What do we mean by modification to a lease? Modification can come in various ways. One of those ways is that you modify a lease, an existing lease, by probably extending the term or trying to terminate or reduce the term or try to modify the use of the asset, which will likely change the lease payments. Therefore, let's look at what constitutes lease modification. Over to you guys. What constitutes lease modification? Who will lead us in our discussion?
Okay, I will. Lease modifications. Lease modification definition. A lease modification is defined as a change in the scope of a lease or the consideration for a lease that was not part of the original terms and conditions of the lease. For example, adding or terminating the right to use one or more underlying assets, or extending or shortening the contractual lease term, IFRS 16 Appendix A.
Okay, now that is that, which means lease is modified once you tamper with the lease term or you tamper with the form of consideration that is attached to that lease or certain conditions. Now, what is also key for us is to identify when does the modification become effective, because it has a role it plays in treating a lease modification. Okay, now the critical aspect of lease modification will be treated as a separate lease. For example, if you lease an asset specifically for 5 years, 2 years into the life of that asset, you have used it for 2 years. In the 3rd year, or at the beginning of the 3rd year, there is an agreement to extend the life of that lease. The question then is, how do we treat that extension? Are we going to treat it as an adjustment to the existing lease, or are we going to treat it as a separate lease? Okay, to answer that question, Segun, you continue with our support to guide us in this discussion. Hold on. Okay, over to you.
Okay. Conditions for treating a lease modification as a separate lease.
Okay.
Okay, a lease modification should be accounted for as a separate lease if both of the following apply. The modification increases the scope of the lease by adding the right to use one or more underlying assets. And 2, the consideration for the lease increases by an amount commensurate with the standalone price for the increases in scope and any appropriate adjustments to that standalone price to reflect the circumstances of the particular contract.
Now, let me explain it one by one. Yeah, thank you. Now, the first one is saying that if you initially lease for 5 years, 2 years has gone, leaving out 3 years, and you tend to extend it for another 2 years. Now, in this situation, these 2 years is going to bring about an increase in the scope of the lease by adding additional rights of one or more underlying assets, which then means that these 2 years will be taken as a separate lease. And these 3 years will be treated the same way we have been treating it before this modification setting. The second one is this. If the lease is such that the nature of the use is to give us 5,000 kilometers per month, and that is given for a consideration of $50,000, for example. Now, the lease is modified so that we can use 7,500 kilometers per month in such a way that we will now start to pay $73,000. Now, the question then is this. This difference is like, this is like 50% increase in your consumption before. And 50% of 50,000 is close to about $25,000. But the increment here, if you look at it, is about $23,000. Now, this $23,000 is close to this 50% of $50,000, which means we can easily believe that there's a discount given because of what you have been doing before now. And when you look at this, this is considered to be at fair price that will have been close to what a standalone price will have been by any other party that wanted to lease a specified asset for that additional 2,500 kilometers per month. And in that case, this adjustment here qualify to separate this modification from this 5,000 and be treated separately as another lease. This is slightly different from the variable payments that will have arose from you increasing your usage of the car. That is marginal. But this is beyond marginal, but this is an increase by an amount that commensurates with the standalone price for increase in the scope and any appropriate adjustment to a standalone price. And that is what is key in this situation. Now, the question then is, when there's a modification, is for us to identify that this modification will require a separate lease to be accounted for only under these two conditions. Whether one, it brings about increase in the scope of the lease by adding the right of use of one or more underlying assets, or a situation where the consideration of the lease have to be increased in which it commensurates with a standalone lease agreement that will have been priced accordingly in that manner. And in that situation, what you will do is that you are required to separate the modification as a new lease from the existing lease. Now, you can continue in our discussion. Proceed.
When the conditions in IFRS 16/44 are met, the modification is considered to result in the creation of a new lease that is separate from the original lease. The agreement for the right to use one or more additional assets is accounted for as a separate lease or leases to which the requirements of IFRS 16 are applied independently on the original lease. The following examples reproduced from the illustrative example accompanying IFRS 16 illustrates a modification that is accounted for as a separate lease.
Now let's look at the example. This example is exactly as lifted from the standard itself. You have the copy of the standard. You can also refer to it. Let's look at this example.
Okay. Modification that is a separate lease. Lessee enters into a 10-year lease for 2,000 square meters of office space. At the beginning of year 6, lessee and lessor agree to amend the original lease for the remaining 5 years to include an additional 3,000 square meters of office space in the same building. The additional space is made
Additional 3,000. Take note of this. To include additional what? 3,000. That is half year into the lease term. We are now modifying it in such a manner that in addition to this 2,000, we want to occupy 3,000. Okay, continue.
The additional space is made available for use by lessee at the end of the second quarter of year 6. The increase in total consideration for the lease is commensurate with the current market rate for the new 3,000 square meters of office space, adjusted for the discount that lessee receives, reflecting that lessor does not incur costs that it would otherwise have incurred if leasing the same space to a new tenant. For example, marketing cost.
Which means
Lessee,
the discount given, is as a result of the fact that the lessee did not incur any cost in entering into the lease by way of marketing, sourcing, and some other things. Neither did he incur costs in modifying the space to fit the purpose. And that's probably why the discount was given. And such discount is acceptable in that manner. Continue.
lessee accounts for the modification as a separate lease, separate from the original 10-year lease. This is because the modification grants lessee an additional right to use an underlying asset, and the increase in consideration for the lease is commensurate with the standalone price of the additional right of use, adjusted to reflect the circumstances of the contract. In this example, the additional underlying asset is the new 3,000 square meters of office space. Accordingly, at the commencement date of the new lease, at the end of the second quarter of year 6, lessee recognizes a right of use assets and a lease liability relating to the lease of the additional 3,000 square meters of office space. Lessee does not make any adjustments to the accounting for the original lease of 2,000 square meters of office space as a result of this modification.
Now, what it simply means is that we now have two leases in one. Yes, the lessor is one single party, the lessee is one single party, but we have two lease contracts. That's what it means. And we are going to account for them separately. Does that make sense?
Yes, sir.
Okay, now let's now look at a situation where the lease modification may not be accounted for separately. What instance would that be?
Okay. Lease modifications that are not accounted for as a separate lease. For a lease modification that is not accounted for as a separate lease, at the effective date of the lease modification, the lessee should A. Allocate the consideration in the modified contract, applying the requirement of IFRS 16, 13 to 16. B. Determine the lease term of the modified lease, applying the requirement of IFRS 16, 18. C. Remeasure the lease liability by discounting the revised lease payments using a revised discount rate. The revised discount rate is determined as 1. The interest rate implicit in the lease for the remainder of the lease term, or 2. If the interest rate implicit in the lease cannot be readily determined, the lessee incremental borrowing rates at the effective dates of the modification. The lessee should account for the remeasurement of the lease liability as follows. A. For lease modification that decrease the scope of the lease by decreasing the carrying amount of the right of use asset to reflect the partial or full termination of the lease. Any gain or loss relating to the partial or full termination of the lease should be recognized in profit or loss. And B, for all other lease modifications, making a corresponding adjustment to the right of use assets.
Okay, now let me break it down for us. From what we discussed here, if the lease modification does not qualify to be shown separately, therefore, it means an adjustment has to be made to existing lease. Now, the adjustment to be made to existing lease for lease modification that do not qualify as a separate lease. Now, this requires what? Adjustments. To existing lease. Now, the adjustments, we need to watch it. The adjustment might be to increase the lease obligation. And the adjustment might be to what? To decrease the lease obligation. Now, how do we treat them? Is a function of what has happened. Now, if the lease will bring about, the modification will bring about increase in the lease, what will now happen is that ultimate adjustment will be to increase the right of use asset. And also what? Increase the lease liability. By what? By the remeasurement adjustment. We are going to see that later, which is similar to what I discussed with you guys on variable payments. Now, these remeasurement adjustments will end up increasing the right of use assets, and given that the life of the, it will now be depreciated over the remaining life of the modified lease, if provided it also affects the lease term. And likewise, the lease liability will be remeasured in that manner based on the revised rate, interest rate implicit in a lease. I'll come to that later. But how do we treat this? This is an exception. And this is usually when you curtail the term of the lease or you terminate the lease in that case. What the standard refers us to do is that the lessee should account for the remeasurement of lease liability as follows. Now, in a situation where the lease modification brings about decrease in the scope of the lease, thereby bringing about reduction in the kind amount of the right of use of assets alongside with the obligation, the lease obligation or the lease liability. And this is done because you want to reflect the partial termination or full termination. In that situation, that reduction could bring about a gain or could bring about a loss if it is onerous. And such should be recognized immediately in profit or loss. Now, if it's a partial reduction or partial termination, it means it's only a portion of the right of use asset that will be derecognized by way of disposal, similar to when you dispose of an asset. And a portion of the liability that is no longer payable, depending on the agreement, will also be derecognized as a liability that has expired, will also come into the disposal account. It is the net of the liability curtailed and the kind amount of the right of use asset that is derecognized that will produce the gain or loss that will be recognized in our profit or loss. And in other instances, where it relates to other lease modification, you have to make corresponding adjustment, which is what we have done here, by increasing the right of use assets and increasing the lease liability. Okay, now the second thing we need to know is In remeasuring the liability, the lease liability the interest rate implicit in the lease will have to be revised. And this will be revised subject to the lease payments payable over the remaining lease term. That is that. That's number one, which means based on the cash flow and other things that is available, we have to remeasure by equating in this formula we had earlier. Remember the formula we make use of is to look at what is the lease payment that is remaining, what is the unguaranteed residual value, if any, and we'll equate that with the fair value of the specified asset as at the modified date and any other initial direct cost that might have been incurred. The new rate, which is synonymous to the internal rate of return that comes out of it, is what will be considered as our revised interest rate implicit in the lease. And that is what we are going to use going forward in recognizing our finance charge with respect to lease liability. Now, let me see whether there's an exercise I can use to display that understanding. Okay, let's read this further and let me try and look for exercise that I can use to explain further. Over to you.
Okay. For the lease modification dealt with under IFRS 16, the original lease is not terminated because there is no decrease in scope. The lessee continues to have the right to use the underlying assets identified in the original lease. For lease modification that increase the scope of a lease, the adjustment to the carrying amount of the right of use asset effectively represents the cost of the additional rights of use acquired as a result of the modification. For lease modifications that change the consideration paid for a lease, the adjustment to the carrying amount of the right of use assets effectively represents a change in the cost of the right of use asset as a result of the modification. The use of a revised discount rate is in remeasuring the lease liability reflects that in modifying the lease, there is a change in the interest rate implicit in the lease, which the discount rate is intended to approximate. IFRS 16.
Okay, now let me give you a practical example. This is a practical example of lease modification that requires separate accounting, and it brings that requires an adjustment. This brings about increase in the scope of the lease by extending the contractual term. Now let's look at this. Okay, Nuruddin, can you assist us here?
Modification that increases the scope of the lease by extending the contractual lease term. Lessee enters into a 10-year lease for 5,000 square meters of office space. The annual lease payments are 100,000 CU payable at the end of each year. The interest rates implicit in the lease cannot be readily determined. Lessee's incremental borrowing rate at the commencement date is 6% per annum. At the beginning of the year 7, lessee and lessor agreed to amend the original lease by extending the contractual lease term by 4 years. The annual lease payments are unchanged, i.e. CU 100,000 payable at the end of each year from year 7 to year 14. Lessee's incremental borrowing rate at the beginning of year 7 is 7% per annum. At the effective date of the modification, at the beginning of year 7, lessee renews the lease liability based on A, an 8-year remaining lease term, B, annual payment of 100,000 CU, and C, lessee's incremental borrowing rate of 7% per annum. The modified lease liability equals 579,130 CU. The lease liability immediately before the modification include the recognition of the interest expense until the end of year 6 is 346,511 CU. Lessee recognizes the difference between the carrying amount of the modified lease liability and the carrying amount of the lease liability immediately before the modification, i.e. 250,619 CU as an adjustment to the right of use assets.
Now, I want us to model this, okay, so that you can see those figures they were calling from the perspective of what we are used to. Now let's copy this model. Okay. Now, what are the information here? The lease was for 10 years originally. Okay, I can put 10 years here. The incremental borrowing rate before was 6%. The payable was payable at the end of each year, which means it's in arrears. How much was payable? 100,000. There's no information about direct costs, no incentive. Okay. Now, we're told that at the beginning of the 7th year, okay, what I'll just try to do is to extend this for 7 years. Okay. No, okay. extended for 10 years. It's originally 10 years, sorry, not 7 years. Okay, now, okay, now let's look at it. This was the entry that was recognized. That was at the inception, that's commencement of the lease. $736,000. Okay, now what was the depreciation? We'll have depreciated the assets for how many years? 10 years. At how much? 73. Now, if you come back to the depreciation, what would have been the value after 7 years? From the information here, we're told that at the beginning of year 7, which means the modification took place at the end of year 6. What would have been the kind amount? The kind amount supposed to be how much? The 6% in arrears. That's the kind amount supposed to be 294. Is that correct? Yes. Okay. Now let's also look at the liability. But what was the liability as at the end of year 6? This is what is important to us. This period, we can grade it off. What is important to us is this. Now, let's go back to the question. Look at it. 100,000 is payable at the end of each year. The interest implicit in the lease was 6% per annum. At the beginning of year 7, the lessee and lessor agreed to amend this, okay? But before amendments, we're told that the modified lease liability equals, okay, this is modified, we'll come to that, but the lease liability immediately before the modification, including the recognition of interest until the end of year 6 is 346,511. Okay, let's check that. What do we have in our own? Can you see it? 346,511. That's how they arrive at it. Okay. Now, let's go back to the stuff. What is the kind amount of the right of use of assets as at that time? We are told that lease increases the difference between the carrying amount of the modified lease liability and the carrying amount of the lease liability immediately before the modification, which is this, as an adjustment to the right of use assets. Now, the difference between this 346,511, how do they arrive at 597,133? I will show you. Now, this is no longer relevant because they've now extended the period. Therefore, this is no longer relevant. This side is no longer relevant because there is a modification. Now, how many years ago originally? Year 7, year 8, year 9, year 10. But if you go back to the question, this has been extended to, if I expand it, this has been extended to 14 years from year 7, which means what I would do is to reconstruct this schedule I have here. Let me just copy it. Let me try and put it somewhere here. Let me return this. Let me put it somewhere here. No. It's infringing on that. Okay, now this is initial year 7. Now year 7 to year 14. This is where it stops. Therefore, this is not relevant for me. Now, this will now start to count as 1 from year 7. You know, we are now at the beginning of year 7, which is 1, year 8, 2, up to year 14, which is 8. Now, what do you do in that scenario or in that instance? Now, our incremental borrowing rate has changed from 6%. If you check, it has been revised now to what? To 7%. Where is it? 7%. Therefore, this is revised. I'll put it there. Revised, which is 7%. Now, on that premise, I'll discount this. For this period. Now, what will I do? After discounting it, I multiply this and get my present values. At the end of the day, what have I done is to sum up everything over this period. And that gives me 620, which is the lease liability as at the modification dates. Which is the first day of year 7. 620. Okay? Okay. The own modification, we're told that the lease liability equals 597 instead of 620. Now let's check. Yeah. Now, if it is the same variables we inputted, 8 years remaining lease term, this is 8 years. Annual payment is still remain at 100,000. Okay. And the borrowing rate is what? 7%. Therefore, we should still have, okay, no. I didn't change this to this rate. It's still picking the 6%. That's where it was wrong. You must always check your model because I've locked it into the first cell at 6%. Now, can you see? I've picked it from 7% now. That is where they got this 597,130 from.
Okay.
Can you see it now? Now, this is the measurement liability. Now, I will now compare this with my lease liability as at 31st December, year 6, which is prior to modification. And what was that one prior to modification? What was prior to the modification is it 346. Now, the difference between that and this is the adjustment, remeasurement adjustment. To 1, right of use assets, and 2, the lease liability. As at the modification date, which is 1st of January, year 7. Okay. What would be the journal entry you pass? Let me just copy a journal entry here. Journal entry for the modification. Which is year 7. Beginning of year 7. It will be debit rights of use assets and credit lease liability. With what? With this remeasurement adjustment. That is what that solution gave us, which means you can do it yourself. Okay, any question, please? Any question? Does that explain it all now?
Yes, it does.
Yeah. Which means going forward now, this increment, the kind amount of the asset will now change.
Yes.
Means in year 7 now, if I want to extend this up through to year 14, see what will happen. This will no longer be this will no longer be 294, it will be 294 plus the adjustment we made. Does that make sense?
Yes, sir.
Now the value is now 4. That's it. It's 294 plus what is that adjustment? The adjustment was 250. Therefore, the value, let's say, AB12, 53. Okay. Let me check out. There's no circular reference. Okay, I think there's circular reference. Let me just copy and paste the value. Okay, it has corrected itself. There's circular reference there. Instead of wasting my time investigating that, I just pasted the value. Therefore, this is a new value, yeah? Now, this new value will now require change to depreciation. One, the useful life has been extended for 8 years. Do you get what I'm saying now? Which means the new depreciation rates, let me call it like this, revise the annual depreciation. Year 7 to 14 will now be this amount divided by the remaining 8 years. Count, how many count is this from year 7 to year 14?
It's
Therefore, this is the new depreciation. This is a new depreciation, which I'm now going to use going forward. I'll lock it, and at the end of 14 years, it is fully depreciated. Now, my liability also, I'll reconstruct my table for liability. I can put my liability here. Therefore, let me take this down. Okay, let me reconstruct it under here. Revised from year 7 to year 14. Okay, year 7, 8 to 14. This was 6% before. Now the revised one is 7%. And what will happen? This new value will be this closing value plus the 250
Plus, yes.
we revised. And this rate, take note, is no longer 6%, it's now 7%. Where's that 7%? Where is it? I use it somewhere. Okay, this is 7%. I'll lock it. Okay. I'll drag that down. Now, the lease payments, remember, it's 100,000 for each period again from year 7. Where's that? Okay, this is year 7. Year 8. Year 9. Year 10. Year 11. Year 12. Year 13. Year 14. Can you see? This is how we extinguish the liability. The same way we depreciate over the many years. Does that make sense now? Does that make sense now?
Yes, sir.
Okay. That is that. Scenario 4. Okay. Let's now go back to another modification that brings about decrease. How do we treat that? Okay, over to you.
Modification that decreases the scope of the lease. Lessee enters into a 10-year lease of 5,000 square meters of office space. The annual lease payments are 50,000 CU payable at the end of each year. The interest rate implicit in the lease cannot be readily determined. Lessee's incremental borrowing rate at the commencement date is 6% per annum. At the beginning of the year 6, lessee and lessor agreed to amend the original lease to reduce the space to only 2,500 square meters of the original space, starting from the end of the first quarter of year 6. The annual fixed lease payments from year 6 to year 10 are 30,000 CU. Lessee's incremental borrowing rates at the beginning of year 6 is 5% per annum.
Okay. In continuation, by giving this information, okay, continue.
Okay, at the beginning of effective date of the modification, at the beginning of year 6, lessees may remeasure the lease liability on the basis of A, a 3-year remaining lease term, B, annual payments of 150,000 CU, and C, lessee's incremental borrowing rates of 7% per annum. The modified liability equals 393,647 CU, of which A, 131,216 CU relates to the increase of 50,000 CU in the annual lease payment from year 6 to year 8, and B, 431 CU relates to the remaining 3 annual lease payments of 100,000 CU from year 6 to year 8.
Okay. Let me give you the answer to it because I'll give it to you to model using the experience you've gained from the one I did earlier. Yeah, go ahead. You can proceed.
Decrease in the lease term. At the effective date of the modification, at the beginning of year 6, the pre-modification right of use asset is 368,004 CU. Lessees determines the proportionate decrease in the carrying amount of the right of use assets based on the remaining right of use assets for the original 2,000 square meters of office space, i.e., the remaining 3 years lease term rather than the original 5 years lease term. The remaining rights of use asset for the original 2,000 square meters of office space is 220,802 CU, i.e., 368,004 CU divided by 5 multiplied by 3 years. As the effective date of the modification, at the beginning of the year 6, the pre-modification lease liability is 421,236 CU. The remaining lease liability for the original 2,000 square meter of the office space is 267,301 CU, i.e., present value of the origin of 3 annual lease payments of 100,000 CU discounted at the original discount rate of 6% per annum. Consequently, lessee reduces the carrying amount of the rights of use assets by 147,202 CU, i.e., 368,004 CU minus 220,802 CU. And the carrying amount of the lessee's difference between the decrease in the lease liability and decrease in the loss at the effective date of the modification at the beginning of year 6. Lease liability, 153,935 CU. The gain, rights of use of assets, 147,202. Gain, 6,733. At the effective date of the modification, at the beginning of year 6, lessee recognizes the effects of the remeasurement of the remaining lease.
Okay, now let me show you the table. And you guys will model it the same way I've modeled the one for increase. Okay, continue.
Liability reflecting the revised discount rate of 7% per annum, which is 4,870. That is 267,301 CU minus 262,431 CU as an adjustment to the right of use assets. Lease liability debits 4,870, right of use assets credit 4,870 CU. Increase in the leased space. At the commencement date of the lease, for the additional 1,500 square meters of space at the beginning of year 6, lessee recognizes the increase in the lease liability related to the increase in scope of 131,216 CU by a present value of 3 annual lease payments of 50,000 CU discounted at the revised interest rate of 7% per annum as an adjustment to the right of use assets. Right of use assets debit 131,216 CU. Lease liability credit 131,216 CU. The modified right of use assets and the modified lease liabilities in relation to the modified lease are as follows. Lease liability, right of use assets, beginning balances, interest expense, lease payment, ending balance, beginning balance, depreciation charge, ending balance from year 6 to year 8.
Okay, thank you very much. Now I've shared the model with you, okay, which also showed the one I've done before. And even in one of the sheets of the model, I've also put all of this question and answer. I want you guys to deliberate on it the way you did in part 1. Just try to attempt it. I'll give you 10 minutes to, although you have the answer, but how do you model it to be able to relate it with what has been done? Okay, I'll give you 10 minutes to do that and we'll return as soon as possible. Okay, we'll try to solve the question now using our model. And once again, I want someone to read this question as presented before you guys. Over to you guys.
Okay, modification that decreases the scope of the lease. Lessee enters into a 10-year lease for 5,000 square meters of office space. The annual lease payments are 50,000 CU payable at the end of each year. The interest rate implicit in the lease cannot be readily determined. Lessee's incremental borrowing rate at the commencement date is 6% per annum. At the beginning of year 6, lessee and lessor agreed to amend the original lease to reduce the space to only 2,500 square meters of the original space, starting from the end of the first quarter of year 6. The annual fixed lease payments, that is from year 6 to year 10, are 30,000 CU. Lessee's incremental borrowing rate at the beginning of year 6 is 5% per annum.
Now see how we attempt to solve the problem. Now, I developed this model. The first thing to understand is that the asset is under lease for 10 years. And the fixed payment per year is 50,000. And it is done in arrears because the payment is made at the end of each year. Now, the incremental borrowing rate is what was available at 6%, which means, yeah, I'll change it to incremental. of the lessee. Okay. It's 6%. And again, the lease term was said to be 10 years. This lease is of office space. Okay, now, without any bias, if we model this for 10 years, according to the question, what we come up with is the sum of 368,000, as you can see here. Okay, looking at it for each of the years. And that's how we arrive at 368, based on our principle of discounting. Now, what do we do? There are no other items like initial direct costs, down payment, incentive, and etc. Our accounting entry is now limited to recognizing the right of use assets to the tune of 368,000 and the lease liability of 368,000. Now, all was well from year 1 up to year 5, which you can see from our analysis here. Depreciation was at 36.8 in thousands because the lease term is 10 years, thereby dividing the cost by 10. And when you go to our depreciation schedule, you'll find out that each year up to year 5, depreciation schedule, okay, this is it here. Each year up to year 5 is being recognized for depreciation. Let me drop the line. Everything seems to be normal up to year 5. Okay, based on the principle of depreciation on a straight line. Likewise, the liability also up to year 5 was measured, given that as at year 5, the present value of the obligation with respect to lease liability was 210,618.19. Furthermore, what happened? If you come back to the question, you find out that we are told that at the beginning of year 6, the lessee and the lessor agreed to amend the original lease to reduce the space to 2,005, which means from 5,000 square meters, we can now occupy 2,005, probably because of COVID-19, we've more or less restructure our business, and certain people can start to work from home. And on that basis, the space we now require is no more than half of the original space. What this presupposes is that we come to our model and immediately derecognize half of our obligation and half of our right of use assets. That's the first thing that comes to mind, without initially taking into cognizance what is the new term, which we are going to come to later. Coming to this, make me come down here to say, okay, I want to know whether there is a gain or loss from this partial termination, because I've terminated 50% of the space. 50% reduction in the liability. Remember, our liability as at the end of year 5 was 210,000, which is this in gray, which means half of it will be derecognized. 50% of the space is terminated, leaving out 50% being retained. Therefore, 50% of this liability will be derecognized. And likewise, 50% of my right of use of this 184 will also be derecognized. At the end of the day, I've derecognized liability, which means I will no longer pay 105,000. Also, I will no longer have access to 92,000 with respect to the value of the space I will have occupied, which means invariably I've made a gain from this arrangement. Okay, how do I pass the entry? I reduce my liability by way of debit of 105, which is the amount to recognize. I reduce my asset, right of use asset, by also 92,000, which is recognized. And I recognize the difference, which is the balancing figure, as gain or loss arising from this arrangement. In this case, it was a gain. Now, if I remove 105 from 210, what is left is 105. If I remove 92 from 184, what is left is 92. Those are the amount I will retain. When you come to my asset account, you find out that I derecognize 92. Now, having derecognized at 92, my new carrying amount at the beginning will not be the 92, which will be depreciated over the remaining 5 years. And that's why our depreciation was halved over the remaining 5 years until it is fully depreciated. That is that. Now for the liability, we no longer need this initial liability section, which is from year 6 to year 10, because it has been modified. Now 210 has been reduced by the amount you derecognize. Let me put somewhere here. My 210, how much was recognized? If you go back to my journal, I recognize 105, which means what is left in my liability is 105. But furthermore, this is what my liability is left with. But let us look at something here. Let me take you back to the question. Now, as a result of reducing this space to 25, okay, the annual fixed payment now for the remaining 5 years is no longer 50,000, but how much? 30,000. Now, this 30,000, the new incremental borrowing rate as at the modified date is 5%. I'll look for the present value of this, and I'll compare it with the carrying amount of my liability. Remember, my carrying amount of liability after the recognition is 105. Now, this 105, I'll compare it with what the present value is from this my new term. I'll no longer be paying 50,000, but I'll be paying 30,000 for the 2,500 square meters. And the new borrowing rate, according to the question, is 5%. Now, 5% discounted across gave me 129, which means 129 is more than the liability I expected to have. That means the modification have brought about increase in my lease obligation. Now I will compare the liability that is left prior to the modification based on what is aft. This 105 is the same 105 I have here. This 105 I have here, which is synonymous to the 50% retention. If you check the link, this 105 is based on the retention, which is highlighted here, retention rate multiplied by the outstanding liability. At the end of the day, my liability have to be increased by the new terms because the new terms seems not to be that favorable. And in that situation, what happened is that I have to, my remeasurement has brought about increase in the liability, and that have to be adjusted against both the right of use assets and the lease liability. Which means if I add 224 to this 105, it brings me back to 129,884, which is what I use to construct my new amortized cost schedule, which is 129. This 129 is as a result of one, the 105, which is left, plus the 24 adjustments that was given. And that gives me that 129,000. That 129,000 is what I now remeasure at the new rate of 5%. If you check the formula, where did I get it from? The 5% is seated at cell J53. Where is it? Cell J53, which you can see here, has been highlighted. And at the end of the day, that is how we constructed our schedule. And that brings us to this position. And this is what it looks like when such modification brings about reduction in the lease obligation. Any other question?
Please, I want to see how you reflect the same adjustments on the right of use assets.
Yeah, this is it. If you go to the right of use assets, you see that apart from the recognition, there was, you could see I recognize 92,000. Okay. Now, this 92,000 brought us to, okay, this 184 minus 92 brought us to 92. Now, there's something that was not captured. I think I have to amend it. We didn't capture the increase in the right of use asset. Therefore, I'll come here, additions. Let me put it in green. There was an addition. What is the addition? 24,000. And what does that signify? Now, what will happen is that this 24,000 will alter my depreciation. Therefore, what will I do? I come back here. What is my new depreciation? The new carrying amount is the sum of the 184 less the recognized amount, sum it up with the new addition, and that gives me the new value, which I would more or less depreciate over the remaining 5 years, which is the count. And What does that give me? It gives me 23,000. At the end of the day, administration is not 18,000 because we omitted that 24, and that is distributed over the remaining 5 years. And that is how we determine our depreciation of the right of use what assets. Does that explain it better now?
Yes, it does.
Yes. Yes.
Okay. That is that. Any other question on that?
Sorry, maybe I didn't get the question right, but I think it was the lease was remodified to 8 years instead of 10 years.
No, that is not the question. You have missed up the question.
It's
the second question. It's the second question. This is the question. Madam, can you read the question once again? That's the question. Can you read it aloud?
Yeah, I've seen it, sir.
Yeah, can you read it aloud once again?
Okay. Leasee enters into a 10-year lease for 5,000 square meters of office space. The annual lease payments are 50,000 CU payable at the end of each year. The interest rate implicit in the lease cannot be readily determined. Leases incremental borrowing rate at the commencement date is 6% per annum. At the beginning of year 6, leasee and lessor agreed to amend the original lease to reduce the space to only 2,500 square meters of the original space, starting from the end of the first quarter of year 6. The annual fixed lease payment from year 6 to year 10, are 30,000 CU. Leases incremental borrowing rate at the beginning of year 6 is 5% per annum. All right, sir. Thank you. I got it.
Thank you. Now, who will volunteer to read the second question? Modification that brought about both increase. You know, we have done increase separately, we have done decrease separately. Yes. But we want to look at a modification that brings about the two at the same time.
Okay. Modification that both increases and decreases the scope of the lease. Okay. Lessee enters into a 10-year lease for 2,000 square meters of office space. The annual lease payments are 100,000 CU payable at the end of each year. The interest rate implicit in lease cannot be readily determined. Lessee's incremental borrowing rate at the commencement date is 6% per annum. At the beginning of year 6, lessee and lessor agreed to amend the original lease to A, include an additional 1,500 square meters of space in the same building, starting from the beginning of year 6, and B, reduce the lease term from 10 years to 8 years. The annual fixed payments for the 3,500 square meters is 150,000 CU, payable at the end of each year from year 6 to year 8. Lessee's incremental borrowing rate at the beginning of year 6 is 7% per annum. The consideration for the increase in scope of 1,500 square meters of space is not commensurate with the standalone price for the increase adjusted to reflect the circumstances of the contract. Consequently, lessee does not account for the increase in scope that adds the right to use an additional 1,500 square meters of space as a separate lease. The pre-modification right of use asset and the pre-modification lease liability is in relation to the lease as follows.
Now, let's try and attempt solving the problem. Now, in information, there's a contract that contains a lease with a specified asset being the office space. Okay. And the fixed payment was 100,000. Frequency was annual. Time of payment is in arrears. There is no initial direct cost. There was no lease incentive. There was no variable payment. And here we have incremental borrowing rates. Let me copy it from here. We don't have the knowledge of the interest rate implicit in the lease, I guess, and we have incremental borrowing rate at 6%. And the lease term is for 10 years. Therefore, in this case, we will pretend as if we are not aware of what happened subsequent so that we don't use the benefit of hindsight. Therefore, what do? We carry out discounting techniques to obtain what is the present value of the lease liability, which comes to 736,008. Remember, the fixed payment was 100,000, no variable payment. At the end of the day, at 6% incremental borrowing rate, we discount this 100,000 over a 10-year period, whether using cumulative discount factor or using discount factor as the case may be, we will both arrive at 736,008 being the lease liability at the commencement date. And since there is no other transaction involved, the right of use asset is recognized to that extent, and likewise our lease liability. That is that. All things were okay from our depreciation schedule here up to year 5. And therefore, I like that. Everything seems to be okay. Up to end of year 5. Our depreciation is influenced by the cost that was recognized divided by the lease term, which is 10 years. I remember we have no knowledge of the useful life, but when you have knowledge of the useful life, it now becomes the shorter of the two as your period, as your basis for depreciation on a straight line. Now on a straight line, 73,600 is being reduced on a yearly basis up to end of year 5, where we have 368,000. Likewise, similar thing can be said of the amortized cost for the lease liability. Up to year 5, we had 421,000. Okay, now what happened? Let's go back to the question. In the question, we are told that at the beginning of year 6, lessee and the lessor agreed to amend the original lease such that 1, they include additional 1,500 square meters of space in the same building, starting from the beginning of year 6. Now, all things being equal, depending when we have subsequent information, what will have come to our mind with this information is that this should be tilted towards a new lease. But there are conditions that must be met before you can say it's a new lease, which have to be treated separately. And one of those conditions is that the value and consideration must be commensurate to what will have been on the standalone price. But let us listen to what has happened. Second thing that has occurred is that this increase now leads to us reducing our number of years from initial 10 years to 8 years, which means it's no longer commensurate on the standalone because there are other conditions attached to it for us to have been able to negotiate this additional. And not only that, the annual fixed rate or payment for the 3,500 square meter, which is the combination of 2,000 and 1,500, is now 150,000. still payable at the end of each year, but now only for 3 years. Now, this has altered the condition that will have made us treat it as a new lease. Furthermore, as at the modified date, the lessee's incremental borrowing rate has increased from 6% to 7% per annum, which means it's a two-way thing. A condition first brings about increase, and another condition brings about what? Decrease, which means it's a 2-in-1 within the scope of the lease. How do we go about it? Coupled with the fact that we have the better understanding of how we treat them individually, where there's an increase, which brings about remeasurements, and where there's a decrease, which brings about recognizing gain or loss, and if any remeasurement that might impact the liability to increase. We are now going to combine this knowledge together in solving this question. But before we proceed, there's another information that corroborated my expression earlier, that the consideration for the increase in the scope of 1,500 square meters of space is not commensurate with the standalone price. If it has been commensurate, we will have treated the 1,500 totally separate as a new lease and only deal with the decrease. But in this case, we are told it's not commensurate with the standalone price for that increase adjusted to reflect the circumstances of the contract. Hence, lessee does not account for increase in the scope that has the right to use additional 1,500 square meters of space as a separate lease. It's not a separate lease. It then means that we'll treat it as a modification or a remeasurement adjustment to the existing lease. How do we do this? We'll go back to our model. Now
I don't know if I can just like ask a question or just request that you go back and explain a little bit more, because I still haven't gotten properly why it is not standalone. You know,
no, they provided us this information. Remember, I said we would have treated it as a standalone, but this information is given to us, given that they've carried out evaluation of what a standalone price will have been for the additional 1,500. Look at this phrase here. It's part of the question. Can you read this, please? Start from D.
Okay. The consideration for the increase in scope of 1,500 square meters of space is not commensurate with the standalone price for the increase, for that increase adjusted to reflect the circumstances of the contract.
Before that, stop at standalone price. Read it again, stop at standalone price.
Okay, the consideration for the increase in scope of 1,500 square meters of space is not commensurate with the standalone price.
Stop. Now, what is the increase? The increase is the difference between the 150,000 and 100,000.
Yes.
The increase is 50,000. The question is, if we have gone outside to lease that same property, if it's another person that came to lease that property at 1,500 square meters, will it have been given to that person at 50,000 for 3 years? What they are telling us is that no.
Okay.
And it is no because in addition to it, there was a condition that says for us to take this additional 1,500 square meters at 50,000, you will reduce our original lease term from 10 years to 8 years.
Okay.
Which means instead of us having remaining 5 years, we only have remaining 3 years. That might have influenced the reason why the price is not at arm's length or it's not at market price.
Okay.
And that's why they gave us this information. But I read it all together again as a full sentence and stop at this contract.
The consideration for the increase in scope of 1,500 square meters of space is not commensurate with the standalone price for that increase adjusted to reflect the circumstances of the contract.
Okay, thereafter, what happened?
Consequently, lessee does not account for the increase in scope that adds the right to use an additional 1,500 square meters of space as a separate lease.
That is it. Does that answer your question?
Perfectly, sir.
Yeah. Now let's go back to our model. Now, on our model, let's pick it one by one. What is our new lease? Now, the present value of the remaining lease liability, I have to measure it, but based on original contractual terms. Now, look at it. Original contractual terms is that I'm to pay 100,000 per year. And my incremental borrowing rate was 6%. If you remember. Now, the same thing I bring down here. But the only thing is that instead of year 6 to get to year 10, year 6 now get to year 8 and stop. But at still original term, the only term that was varied is the tenor that was cancelled out. Therefore, what will have been my liability based on original term, except for the fact that I didn't reach 10 years? And that liability will be 267,000, which is from this our present value principle. Now you will compare this liability with your pre-modified liability, that is liability given that there was no modification at all. And that is the liability we had there. 421. As at the time we want to modify, this was what was outstanding. Let us compare it with what has now been modified without considering the increase. We are just looking at what we have original term of, what's it called, 2,000 square meter, which was 100,000 per year. Now, the difference here is the portion we recognize. This is synonymous to what we did in the other question. Yeah. The reason why this one was straightforward is because it was halved. Therefore, it makes it easy to get. Instead of me wasting time discounting, finding the difference, because it is half, 50-50, it just makes it straightforward. Now, because in this case, it's not 50-50, and because there's time value of money impacting it, therefore, I have to work it out myself. Which means if I've used the same methodology here in the first question or first scenario here, you still get the same answer because it's 50-50. But you won't get the same answer if you have done 40-50 for what has time value of money. But you find out that we did 40-60 for depreciation because depreciation does not carry time value of money. It's historical cost and it is spread equally. Okay, and that is that. Which then means that once I compare this, it means this was initial liability based on original term for 5 years remaining. We now compare it with the liability on the original term, but for 3 years, which means the 2-year value you recognize is 153,000. That is that. Now, because depreciation does not have time value of money impact, I can do that one very straightforward. And what is that? This was a kind amount, 368,000. As at the end of year 5, which was the value at the beginning of year 6, 40% of it were recognized. Why? Because this 368 is for 5 years remaining, of which 2 years has been cancelled out, which means 2 years cancelled out, the proportion of that must be recognized, which is like you're accelerating the depreciation. Okay, and recognize 147,000. This 147,000, where is it coming from? It's coming from this place which represents 40% reduction in the right of use of assets. Where is this 40% coming from? It is from here. How do you arrive at it? 2 years will be terminated out of the remaining 5 years. And that proportion is what gave me 40. And what is retained is the balance, which is 60%, 3 years. Now, 40% of the balance in the carrying amount of the right of use asset will also be recognized. At the end of the day, we had a gain because the value of liability terminated is more than the value of asset terminated. And that is what brought about this accounting entry that was entered at the beginning of year 6, where lease liability was recognized to the tune of 153,935.18. And right of use asset was recognized up to the level of 147,201.7. At the end of the day, we had a gain of 6,733.44. And that is that. But this only deals now with aspect of decrease in the lease term. Okay, now, but this decrease also comes with an adjustment or a measurement adjustment. If you go back to the question, this decrease brought about, as at the modification date, the lessee incremental borrowing rate has increased from 6% to what? 7%. Now, what is the impact of movement of 6% to 7%, which means 1% on the remaining value? What impact does that hold? And how do we treat it? Let's check the impact first before we know the treatment. Now, let's look at the impact. Modified lease payment attributable to change in incremental borrowing rate from 6% to 7%. Now, you know, when we're doing this, we only assume that the rate has not changed at 6%. Therefore, the rate has changed at 6% to 7%. The difference arising or attributed to that rate, what is it? And what impact does that have before we treat it? Now we'll come here and say, okay, let me discount it at 7%. If I've discounted it at 7%, which is the incremental borrowing rate as at the modification date, what I will have gotten is 262, a lower value because of higher discount rates. Therefore, I now compare it with if I've discounted it at the original rate of 6%, which was this 267 we did earlier, this 267. Now, you now find out that your liability has been overstated by 4,869. And this brings about remeasurement adjustments. And this remeasurement adjustment is a decrease, which means your liability must be reduced from 267 back to 262, based on the fact that your incremental borrowing rate has changed as at the measurement, as at the modification date. Now, that brings about decrease in liability and decrease in an asset. And that ends that. All of this was attributed to the fact that there was a decrease or partial termination of the lease condition or term. Now, let's now address the increase. If you go back to our question, the information attributable to the increase is as shown in this question. That the increase will bring about 150,000 payable rather than 100,000, which means the difference between these is 50,000 that can be attributed to occupying additional 1,500 square meters for the next 3 years. Now, what do we do with respect to this? We measure the liability in line with how we'll have treated an increase arising from modification. And in that case, what do? We come here, 50,000 is the increment. Let me put it there. It's a fixed payment, but it was incremental as a result of incremental as a result of modification. Okay, and we're going to pay it for the next 3 years. But again, remember, the new rate is 7% at the modification date. And we discount this to arrive at 131,000. This 131,000, as at the beginning of year 6, will bring about remeasurement adjustments that will use to increase our right of use assets and increase our obligation like this. Now, what does this pertain to our assets and liabilities? Let me start with assets. Initially, our kind amount of assets as at the end of year 5 was 368,000, which we brought forward. Don't forget, we recognized 147,000. Now, there is now addition. But you see that what I put here is net addition. Why? There was initial addition that is not 126. The initial addition from our analysis here was 131,215. But there was a corresponding remeasurement adjustment that reduced our asset value by 4,000.
As a result of increase in interest rates.
Borrowing rates.
Borrowing rates, yes.
Yes. Now, the net of this, 131 minus 148 minus 4,869 is what brought about the net adjustment you are seeing here. The net addition, which we are seeing here. Okay, now my new kind amount will be 368 less the recognized amount, 147, add addition, 126, which means what I have is 347, which will be depreciated over the remaining lease term of 3 years. And that is what brought about the depreciation of 115,000, which you can see here. The sum of this over the count of the remaining years. And that is that. Now for the liability, how does that affect liability? For the liability, remember that it was 421 before. But we closed with 421 as at end of year 5, but we are opening with 393 as at beginning of year 6. What has happened? What has happened is as follows. The lease liability as at 1st of January, year 6, is as follows. Initial balance. Year 5. What was our initial balance in year 5? $421. Less amount recognized based on modification of lease term. How much was that? Amount recognized was 153. Less remeasurement adjustments from borrowing rates from incremental borrowing rate. Let me write it in full. of the lessee. Okay, let's add the remeasurement adjustment from increase in the occupied office space. Now, remember there was a reduction from the incremental borrowing rate, which was this, and there was an increase from the new office space that was occupied. We'll sum everything up. Let me shift it upward. That is how we got the 393, which is the new balance. I can link it. It's still the same operation I carried out here. Okay, and that is 393. Let me find a line. Let me put this line so that I link it together. Okay. That is that. And we're measuring the liability going forward at 150 and at rate of 7% will bring us to nil amount at the end of the day. Does it make sense?
It does
it make sense?
It makes sense, yes.
Yeah, that is that. I don't think you can come across anything as complex again in practice beyond what it is here. Which means the fundamental principle is what we have laid down. You can always modify it to suit any situation or modification that may have arisen from it in practice. Okay. Any other question?
What I'm going to do now is, though the explanation is clear, but I want to make sure I prepare this model by myself, you know.
Yeah.
Then that is when I'll be sure that I've really gotten it perfectly.
Yeah, that's why you have the video to support you to carry out your revisions. Okay, now let me show you the last scenario we might look at for a modification. Okay. These are similar solutions to what I've just discussed. These are just the, for you to read more of it other than using the model. Okay, can somebody read this for me? Modification that is a change in consideration only. What happened in that situation?
Okay, modification that is a change in consideration only. Lessee enters into a 10-year lease for 5,000 square meters of office space. At the beginning of year 6, lessee and lessor agree to amend the original lease for the remaining 5 years to reduce the lease payment from 100,000 CU per year to 95,000 CU per year. The interest rate implicit in the lease cannot be readily determined. Lessee's incremental borrowing rate at the commencement date is 6% per annum. Lessee's incremental borrowing rate at the beginning of year 6 is 7% per annum. The annual lease payments are payable at the end of each year. At the effective date of the modification, that is at the beginning of year 6, lessee remeasures the lease liability based on A, a 5-year remaining lease term, B, annual payment of 95,000 CU, and C, lessee's incremental borrowing rate of 7% per annum. Lessee recognizes difference between the carrying amount of the modified liability, that is 389,519 CU, and the lease liability immediately before the modification, that is 421,236 CU, of 31,717 CU as an adjustment to the rights of use assets.
What have you done in that case is that anytime the modification arose from just change the consideration, this is more or less like there was an incentive that was given. And how do you treat that? Okay, what is being said is that you are going to treat it as a remeasurement adjustment to probably reduce the carrying amount of both the liability and the right of use what assets. Okay, which means you won't necessarily recognize gain or loss. You are only going to recognize commensurate reduction in both the value of the assets and the value of the liability. Therefore, if you look at this now, okay, let me try and model it for you. I'll have said you should model it yourself. Let me try and model it and see what we can produce from it. Okay, let me switch to my model. Okay, it's a lease of office space. Okay, and the lease term, the lease payment was 100,000 in arrears. The initial incremental borrowing rate was incremental borrowing rate. Let me copy that. Okay. Now, the lease term is 10 years originally from the information. Now, all things were okay until when? Okay, until beginning of year 5, which means if we go by this term, the initial value was 738,000. Okay, from our discounting principle. Therefore, what do? Our depreciation over 5 years will have been okay. There's no problem in the first 5 years. And it means our value was 368,000. Okay. Similarly, our value was okay for the first 5 years, Yeah. Before what happened in year 6. Therefore, I will extend my red line up to year 6. Now I have 421,000. Okay, up to year 6, year 5. Now, what has happened? As at the beginning of year 6, there was an amendment, which then means that the amendment is such that from year 6 to year 10, sorry, year 6, 7, 9, 10, okay? What is my new value? I sum this up. And what has changed? This is no longer 100,000, it's 95,000. Now, I link everything up to 95,000, which is a new rate consideration. More or less, I was given a discount. Okay, and unfortunately, or fortunately, as the case may be, depending on how it affects me, my incremental borrowing rate has moved, if you go back to the question, from 6% to 7%. Therefore, I change my rate to 7% here. Now, the new value thereafter has now shown 389,518. I will compare that, which is the lease liability as at the beginning of year 6. I'll compare it with the lease liability as at the end of year 5 before the modification. And that is how much? That was 421. 421. Therefore, what has happened? There is a reduction in my liability, which is like a rebate to the tune of 31,000. What will happen is that I'll reduce my what? My liability by that amount, which means I'll debit my liability by the remeasurement adjustment and credit my right of use assets. And that is it. And this is what will be done at the beginning of year 6. And that is what was stated there. You can say now. That's what was stated here. Now, what that will mean is that if I go to my asset account here, my right of use assets, now for the remaining years, I'll come here to write an adjustment. All right. I'll come back to adjust for that. I don't need up to this period. If I take those ones out, okay, what happens? The recognition occurs as a result of modification. Let me just put the recognition on modification. Let me put it in red. And that occurred at the beginning of year 6. And what was that? Okay, at the end of the day, my revised depreciation from year 6 to year 10 will be based on the sum of 368 and negative 31 because of the derecognition. And I'll more or less divide it over the remaining count of the years from year 6 to year 10. And that gives me a new depreciation rate. Sorry.
Okay.
And to run for the remaining period. Sorry, there's no negative here. Why? And this is how it will run to the end of the year. And you can see how it runs. The new rate runs from this period to this period. Okay, that is that. Now, the liability side. We run from year 6 to year 10. 6, 7 to year 10. And what is the value? Remember, the value will be the initial value less the adjustments arising from remeasurement. And that brings about this. And everything come to shape. And that's what happened going forward from year 6 to year 10. Any question? Any question? Okay. Now, we thought we would be able to complete today, but probably because I decided to change the narrative by engaging you guys in the financial modeling for this modification. It has taken a lot of time. And what will now happen is that tomorrow we'll continue from where we stopped, given that we have holiday in Nigeria, but I believe Shegun should be able to join us. Probably you are working from home, but tomorrow's session should be more shorter, probably 2 hours. We should be up. That means we will extend this to part 3 invariably, and that's what it's going to be. Because tomorrow we'll be looking at sales and leaseback from the angle of the lessee, and thereafter we'll move to accounting from the angle of the lessor. All what we have been doing is from the angle of the lessee, which is the most critical aspect. What we wrap up that is the sales and leaseback. And furthermore, we'll discuss lessor's accounting, which is much easier. And we'll wrap it up with disclosure requirements in line with IFRS 16. Any other question? Any other question? Okay, in the absence of no question, we'll call it a day. Thank you very much, and God bless you all.
Thank you.
Thank you, sir.